So this is the financial focus portion of our webinar, and today's financial focus is Roth conversion, break even, and opportunity costs. So this is a question I get, or these are questions I get all the time, whether it's coming out of class or just talking to individuals as they reach out to us, schedule time with us, what have you. And if you want to schedule time with us, there's a link in the description of this video, or you can reach out to us at questions@attleborowealth.com, questions@attleborowealth.com, and that's for a 15-minute discovery call. But these questions are, we talk a lot about the tool that we have and the power of this Roth conversion strategy, but often people say, well, what's my break-even point? If I convert $100,000, how long does it take for me to make up that money that I pay tax, the difference? And sometimes it's not how much time, it's how much growth. What about that growth? What about that opportunity cost? I send money to the IRS. Now that money's gone. It doesn't get a chance to grow. So does it really make sense to do this thing called a Roth conversion if I'm sending my money away and it never has an opportunity to grow for me? And what is that? How much do I need to earn for that to break even? They're really good questions, and we're going to explore them. And I think it's going to be eye-opening for you. It may be eye-opening for you. So first, let's talk about Roth conversions basics. So what is a Roth conversion? So very simply, I'm not going to get into too many details. We're just going to look at it simply. And I've got our buckets here, your taxable bucket, your tax deferred bucket, and your tax advantage bucket. And if you've followed this video at all, and if I guess I should say, if you haven't already, hit the subscribe, like, and notification buttons so that you're always notified about these videos. But we know that your taxable bucket holds everything that is not a retirement account. Let's just keep it simple, right? So your individual mutual funds, your individual stocks, your individual bonds, and you get 1099s for that come out of this bucket. And the 1099s are for interest, dividends, capital gains, whether they be short-term or long-term gains. Sometimes you get K1 reports out of here, but all these equal tax. So these are forever taxed. So my mentor and friend Ed Slott would say that these buckets here, your taxable and your tax deferred buckets, are forever tax buckets. So then you've got your tax deferred bucket. So your tax deferred bucket is anything you've promised to pay later, right? So we've got your IRAs, your 401ks, 403bs, all traditional. They got the tag traditional in front of them. So you put money in, you either get a tax deduction or you get you don't pay tax on the payroll deduction that goes in your retirement account. But the deal is you pay tax later when it grows. The IRS or the tax code has this term, it's either taxed on the seed or on the harvest. With tax deferred, you're taxed on the harvest. So your 100,000 grows to 200,000. You're taxed on the 200,000. And then we have tax advantage. So in this example, we're talking about Roth. So anything Roth, whether it's a Roth IRA, Roth 401k, Roth 403b, Roth SEP now, Roth 457 plan, and I'm sure that I'm missing something, right? But anything with the tag of Roth in front of it. Now, that is money that's already been taxed, right? So you paid tax on the seed when the money went into here. And then as that money grows, you don't pay tax on any of that growth or distributions on that growth as long as you meet some of the qualifications. Really kind of simple qualifications. There's a 5-year rule. We won't get into that today, but there's a 5-year rule that says, a qualified distribution for earnings has to be held. You have to be over 59.5, and you have to have held had an IRA account, a Roth IRA account for more than 5 years. So what are we talking about? When we're talking about conversions. So there's 2 ways to get money into Roth. One of them is contributions, and the other is conversions. So today we're going to talk about conversions. The tax code allows us to take a distribution from an IRA and deposit it in a Roth IRA. And all we have to do is pay tax on that. So figuring out how much we're going to convert every year is kind of the art and the science behind how we move funds. But we're just going to use the numbers we have in front of us to talk about this break-even and opportunity cost. So let's say, for example, you've got $100,000 in your IRA, that you want to move to Roth. And that could be all of your IRA or it could be a portion of your IRA. But this year in 2024, you have $100,000 that you want to convert from your traditional IRA to a Roth IRA. Well, we know that rules allow that. There's no limitations on how much you can convert. You can convert as little or as much as you like. And if you had a gajillion dollars in that traditional IRA, you could, in fact, convert it to a Roth IRA, pay the tax, and that would be done. If you have a gajillion dollars in your IRA, please contact me immediately so we can review that. But you can also do as little as you want. You can convert $1,000 or $100. So there's a lot of room there, and really no speed limits, as I always say, with Roth conversions. The question is, how much tax do you pay, right? So that's really the question during that conversion. So for this example, let's say that you're going to convert this entire $100,000 in 2024, and we know, for example, that your tax rate is 20%. So there's two different ways that you can pay that tax. You can withhold that 20% and have that $20,000, right? That's $20,000 in tax. 20% is $20,000. That's going to go to the IRS for that conversion. So you can either withhold those funds, so that $20,000 goes to the IRS, never to be seen again. And then $80,000, let me clean this up. $80,000 ends up in the Roth IRA. So that's method number one for paying that tax, because you had to pay the tax on the Roth conversion. Now, here's where people say, well, geez, I had $100,000. Now I only have $80,000. So now I got to make up that $20,000 to reach my break-even point. But do you really have to make up that $20,000? Well, let's look at it. If your $100,000, let's come back here. If your $100,000 grows at 7%, for 10.2 years. I say that because that's the rule of 72. If your money grows at 7% in 10.2 years, that money will double. Now you've got $200,000, and you say, well, geez, Mark. See, if I would have moved that, I certainly would have had less in my Roth IRA. And that's true, actually, right? So because if you take the same number and you take the $80,000 and you grow that by 7% for that same period of time, 10.2 years, you're doubling it. You have $160,000. Well, $200,000 is less than, $160,000 is less than $200,000. So I'm kind of proving it out, right? Now I haven't achieved my break even. But for there to truly be a break even, I'm doing air quotes if you're just listening, that has to assume that tax is never paid on the $200,000. Because if you just pay the same tax rate, now you want to take that money out, that $200,000. You're going to take it out and spend it, buy a boat, do whatever you're going to do in retirement. Well, you're going to have to pay tax on it. Let's assume, right? So this is you. You're going to spend or distribute for some reason. You're going to spend that $200,000. Now you're still at the same 20% tax rate in this example. What is $200,000 times 20%? Well, that's $40,000. So your spendable amount of money on that $200,000 is in fact $160,000. You've already paid the tax on the conversion at $80,000, had that growth of 7% over 10.2 years in that example. You doubled your money, and then you end up with $160,000 of spendable money because it's after tax in your Roth. Because anything that you take out of here, you don't pay tax on as long as it's qualified distribution. Anything that you take out of this bucket to spend, well, that you have to pay tax on it. So if the tax is the same and you take that full amount out, then you've got to pay tax, and that tax is $40,000, and you end up with the same net amount, $160,000 here, $160,000 here. It's the same amount of money. I hope that makes sense. So then the only variable is the future of tax rates, because if taxes go up just 1%, And now instead of $20,000, right? So your net here is $160,000 at 20%. Instead of that, what if it just goes up 1%? Now we're at $200,000 times 0.21 or 21%. So we end up with $42,000 in tax, $42,000 in tax, and $158,000 of spendable money. So in this case, it's not the same. You have more spendable money in your Roth than you would in your traditional IRA. Therefore, there really is no break even. The only way that break even really exists is assuming that you never pay tax out of that bucket, that traditional IRA bucket. And there's very, very few ways to do that. And if there is a way, if you know, for example, that you're going to send this $200,000 to charity, then you shouldn't pay. You shouldn't do a Roth conversion. But if you're going to spend it yourself, or if you're going to pass it to your heirs for them to use, the only variable is the future of tax rates. So if you think taxes are going to be at least 1% higher, you gain ground by putting it into the Roth. If you think they're going to be lower, then it probably doesn't make sense to do a Roth conversion. If you think they're going to be the same, you might want to do it anyway because you're eliminating the risk of future taxes. So the variables being, you got the same amount of growth, you got the same amount of dollars, you got the same amount of tax. The tax has to be paid at some point. Do you pay it now when you know what tax rates are, or do you wait and pay it later when we don't know what tax rates are going to be? But experts, including the folks I have the good fortune to work with, project that your average middle class American is going to be in the 40 to 50% effective tax rate in the future. And that, of course, is greater than where we are today. So I hope that makes sense from a break even. And I hope you see, well, that's kind of simple when you look at it, because the only reason that break even really exists, I know I'm repeating myself, but I want to, is if this money that comes out of the tax deferred bucket is in fact never taxed. Once you pay tax on it, once you have to pay tax, the only variable is the future of tax rates. If you think that taxes are going up, you may want to consider a Roth conversion. If you think taxes are going to go down in the future, well, you may want to stay right where you are. Now, what about this opportunity cost? Well, what about that $20,000? I understand the withholding, but what if we paid $20,000 out of this taxable bucket? So what if the whole $100,000 got converted over to here? But geez, I could have used this money and instead of sending this to the IRS, never to be seen again, I could have used that money and it could have grown. Well, you could have, and it's really the same math. So if you would have used this money, if it would have grown, and it would have grown the same amount, 7% over 10.2 years, and now it would have grown to $40,000. And then you would have wanted to use this money, the $20,000, either as a lump sum or even over time, you would need $40,000 to pay the tax on that distribution of the $200,000 at some point in the future, in this case, 10 years later. So it really is the same math. It's the same variable on the opportunity cost. In fact, it's a little more, there's more to it, because you'd have capital gains tax here. So not only ordinary income tax here, but if truly you doubled this money, you're going to have, depending on your income, you're probably going to have a capital gains tax that would make this even less attractive to wait and have that growth within those funds. So that opportunity cost argument is really out the window too if you ever have to eventually pay tax. And there are only few instances where IRAs can be distributed without tax, and they're really charitable contributions. Or if you have a standard deduction that offsets that distribution. So I hope that clears that up. There are other so really there is no break-even point. It all has to do with the future of tax rates. There really is no opportunity cost. It all has to do with the future of tax rates. There are plenty of other considerations when you're talking about Roth conversions. Your effective tax rate, your IRMA charges if you're nearing 65 or over 65. Your cash flow. There's several other considerations, but I hope that puts that question to rest for at least a little while. We may come back to it in a couple of years. And I wanted to share this video just to make sure that we have clarity on that. But I also wanted to create the video so I could send it to folks who have that question, because again, we see it all the time. So I hope that was helpful. That is the webinar for today. We're a little early today, so that's good. I'm sitting here watching my watch. I don't see any questions. It was great seeing you all. I look forward to seeing you next week. If you have questions for me, if you want to schedule time, that 15-minute strategy or discovery call, if you're not a client of ours, you can reach out to us at questions@attleborowealth.com. There's also the link in the description. Otherwise, I look forward to seeing you next week and discussing new topics. Take care. Have a great week.